Let's now go through the consolidated income statement, and we'll use Austin Cycle Shop as an example. You'll also find the same example in my book, Seeing the Big Picture. Now, as I go through this income statement, I'd like to do three things. First, I'd like to give you a quick overview of the statement, then show you how I would analyze the statement if I had just a minute, and then how I would analyze it if I had 30 minutes. Now, as you look at this income statement, most people would refer to it as a P&L, which is short for profit and loss. You may also hear the term earnings statement. I'll generally refer to it as a P&L. Now, you'll also notice in the title it says consolidated, which means that all subsidiaries for Austin Cycle Shop are in this same income statement. It may not mean much for a small company like Austin's, but if you were looking at a large company like General Electric, for example, which has many different subsidiaries, it means that all of those subsidiaries' results are consolidated into this one statement. Now, you'll notice at the top it says for the year ended December 31st for 2012, 2011, and 2010. So you're seeing 3 years worth of results. And the fiscal year end for Austin's happens to be the same as a calendar year end. And many companies do it that way, but occasionally you'll find companies that have a fiscal year end different than a calendar year end. For example, if you look at retailers, it's hard to imagine them trying to close out their year end at the same time they have their busiest shopping season of the year. Now, if I were to summarize this P&L in just 3 lines, it would be sales minus costs equals profit. And let's take a look. As you look at the statement, you'll see our very top line is total revenue, which is the same as sales. And many CEOs will also call this line their top line because it's the top line of the P&L. Well, if this is the top line, the bottom line then is net income. And net income is also referred to as profit or a company's bottom line. And in between sales at the top, or total revenue at the top, and net income at the bottom, you'll see all of the company's costs. Now, as you look at the net income for Austin's for 2012, it reads $1,087. But if you'll notice right under consolidated income statement, it says in thousands except per share amounts. That means that we read each of these numbers by adding 3 zeros to it because it's in thousands. So Austin's net income is actually $1,087,000. Now, as you look at Austin's net income, of course you would like that to be higher. And there are really 2 levers to do that. One is to increase the company's total revenue, and the other option would be to decrease the company's costs. I'd now like to show you what I would do if I only had a minute to analyze a P&L. Here are the things that I would do. First, I would look at the company's total revenue and see how it was growing year over year. And in this case, for Austin Cycle Shop, it went up 15% between 2011 and 2012, so that's certainly headed in the right direction. Next, I would look to see how much net income grew by in the last year. And you can see between 2011 and 2012, net income went up by 28%. The next thing I would do is look at the company's net profit margin. And as you look at net income as a percent of total revenue, it's 13%, meaning for every dollar of revenue Austin Cycle Shop sold, it generated 13 cents to its bottom line. And one of the things you'd want to do is compare that to other companies in your industry to see if you're more profitable or less profitable than the average company. Now that we've analyzed the P&L in just a minute, let's now look at how we would analyze this if we had 30 minutes. So going back to looking at our top line first, instead of looking at just 2011 over 2012, I'd compare that growth of 15% to how much total revenue went up in 2010 to 2011. And we'll see that it went up 13%. Now, what this tells us is not only is Austin Cycle Shop growing, but it's growing at an increasing rate, which is a good sign. If we now go down to the bottom line, or net income, we can see that from 2011 to 2012, it went up 28%, and from 2010 to 2011, it went up 24%. So another thing we learn is that net income is also growing at an increasing rate, which is also a good sign for Austin Cycle Shop. Now, what's interesting is you see that bottom line, or the net income line, is growing faster than total revenue, or the top line. And for a mature company, that's actually what you would like to see. Contrast that with a startup. If you're just starting a brand new company, you may be more interested in growing sales versus your bottom line profit. And the reason being, you're trying to build a customer base, you're trying to build a footprint. But once a company reaches a more mature stage, you'd like to see profits growing faster than sales. It suggests that you've got a management team that can not only grow the company, but they can do it with increasing economies of scale, increasing efficiencies, and increasing profits. Now, if you see the bottom line growing faster than the top line, it tells you that costs are going up at a slower rate than your sales are going up. Let me give you a couple of examples. Let's look at a situation where we've got sales of $100, we have costs of $90, and of course in this case profit would be $10. Now what happens when sales and costs both go up or increase at a 10% rate? Well, in this case sales would now be $110, costs would go up to $99, and our profit would be $11. So when sales and costs go up at a rate of 10%, profits go up at the same rate of 10%. Now, what if your sales were to go up 10%, but you were able to keep your costs the same? Well, using the same example, our sales would be, again, $110, but if our costs were $90, meaning they didn't change at all, that would give us a profit of $20. Or our profits would have gone up by 100%. So when a company is able to grow sales but keep costs relatively flat or grow it at a slower rate, you can see you can get a good increase in your bottom line. Let's now apply what we've learned to Austin's income statement. And what I'll do is look at each expense line item and look at how it's grown year over year between 2011 and 2012. And let's start with the first expense line item of cost of goods sold. And there are two primary items here. One is the cost of raw materials, and the other is direct labor, which is the labor cost of actually producing the product or service. These are sometimes referred to as variable costs because they go up or down based on the level of sales that you have in the business. And this went up 10% for Austin's between 2011 and 2012. Austin's gross profit, therefore, went from $3 million to $3,700,000. Let's look at the next set of expenses, which are called operating expenses, and sometimes referred to as fixed costs because they're not directly tied to the costs of goods sold, meaning they'll generally be fixed whether you're selling more or less product. The first operating expense is research and development, which went up 14% from 2011 and 2012. Now you want to be careful and not cut that line item because that could impact your future sales, which is the same for sales and marketing right below that, which went up 16%. If you're cutting your sales and marketing expense, that might impact future sales as well. Below that, you'll see the general and administrative line item, which went up 16%. This is often referred to as G&A or overhead, and this line item does get a lot of focus and attention when a company is trying to cut costs. The next line item is depreciation and amortization. This is a non-cash expense which reflects the diminished value of property and plant and equipment for the year. For example, your buildings, your machinery or tools. As you use those over time, the value of those decreases, and that's what's reflected here in depreciation and amortization, which went up 48%. Now, when you add those four together, you'll get your total operating expenses, which went up 21% from 2011 to 2012. And of course, when you subtract out operating expenses, you come to the operating income line item. Now, some CEOs will call this EBIT, which stands for earnings before interest and tax. And you'll see a lot of focus on this line item because below this is interest and taxes, which the average person can't do much about. But employees can impact operating expenses and cost of goods sold. So that's why you'll see operating income, operating profit, or EBIT, a line item that many executives focus on. Well, below that, you'll see interest income. This is not an expense, but actually money made from Austin's cash on hand and investments. It went up 50% from 2011 to 2012. That line item going up is actually a good thing. Below that is interest expense, which is what Austin is paying for the money that he has borrowed, and that went up 81%. Now, although that was a big increase, you'll notice that it's a very small expense line item compared to some of the others. Once you take out interest income and interest expense, we now have income before provision for income taxes. And Austin's provision for income taxes actually went up 28% from 2011 to 2012. Now let's step back and look at all of Austin's expenses. And you'll notice that all of them grew at a faster rate than sales, except for two, and that was cost of goods sold and research and development. Now, what's important is that cost of goods sold only went up 10%, and it's the biggest expense line item that Austin has. So the answer to why Austin's profit grew faster than his sales is that he was able to manage his cost of goods sold. So even though Austin's cost of goods sold did go up, it was only at a rate of 10%, which was lower than Austin's total revenue growth of 15%. Let's focus on the net income per common share diluted. That number you read is 25 cents. Now, we're not adding 3 zeros to that because as you look under the consolidated income statement heading at the top below that, in parentheses it says in thousands except per share amount. So this is a per share amount and it is 25 cents. And how you calculate that is you take your net income of 1,087,000 and you divide that by 4,300 shares, which gives you 0.25 or 25 cents. Now, of course, the company would like to increase its earnings per share because that drives stock price. And here are your two levers. You can either increase net income or you can decrease the number of shares. That explains why many companies will use excess cash to buy back shares of stock, which they retire. And thus, by reducing the number of shares, it improves that diluted earnings per share number. Now, you'll notice that Austin's number of shares used in per share calculation, both basic and diluted, has actually gone up over the last 3 years. That's not likely because he's done a secondary offering. It's reflective of additional stock options that have been given to employees and then they've exercised those options, which then increases the share count. Of all the financial statements, the P&L is probably the most important one because it's the one that you and I can impact most.